Welcome to the ICO Alert Podcast. I'm your host, Mike Finch, COO and co-founder of ICO Alert. Today, I have two awesome guests, Frank Chaparro and Travis Kling. Frank comes to us from Business Insider. He also goes by FinTech Frank, and has some really awesome perspective over there. Has some top regulatory bodies and top personas in the traditional financial and crypto financial space, if you will, on the line at all times. Definitely check his stuff out, check his Twitter out. The other gentleman, Travis Kling, comes from the hedge fund space, who now has recently started ICO Fund, which is a crypto hedge fund, who, as you'll see in this podcast, is doing some pretty awesome things, really, in my point of view, setting the standard for the way that these crypto hedge funds should be thinking about the context of the industry, way to look at the market, way to evaluate these various crypto assets, anything from Bitcoin to a private sale of a brand new ICO or STO. So really hope you guys enjoy. It's a bit of a longer one. I think probably the longest one we've ever done, but tons of content, lots to listen to here. So enjoy. Well, really appreciate having both of you guys here on the podcast. I want to start off and have you guys introduce each of yourselves. So, Frank, if you want to start, that'd be awesome.
Yeah, thanks for having me on. So basically, I'm Business Insider's, not their only crypto reporter, but I focus on the intersection of Wall Street and digital assets with a focus on trading, firms like Jump and Jane Street and Virtu, and exchanges like NASDAQ, CME, CBOE, and obviously what they're doing in equities, but obviously what they're doing in crypto, which is more than what you see on the asset management side, and then crypto exchanges, crypto funds, and also diving into digital wealth management, and I cover Morgan Stanley too.
Gotcha. And people call you FinTech Frank as well. How'd you get that name?
So I in a previous life, not too long ago, I really stumbled into crypto from reporting on financial technology. I remember, must have been a year ago, my editor says to me, do you want to write about this magic internet money? And I said, yeah, I can do that. But I used to write about Lending Club and still do write about the robo-advisors like Betterment and Wealthfront. But that's where I sort of started. When I started at the BI, those were some of the firms I wrote about.
Gotcha. Give me an example of something you're writing about today.
Yeah, so it's interesting. Got off the phone this morning with president of CBOE, Chris Kincannon, and we are sort of looking at, what the SEC said about Ether, right, and how it's not a security. But I don't think they're out of the woods just yet, or folks in the community aren't out of the woods just yet with respects to whether that initial fundraise, that first, ICO in a sense that created the ecosystem, could those folks be liable to, certain unregistered security law type things? And I think that question is something that folks across the space for ICOs need to think about. And so he basically thinks there's going to be a reckoning in two waves. The first being the SEC going after some of these ICOs that are unregistered securities, right? And then a second wave of big law firms seeing a huge opportunity to start class action lawsuits. Because if you are, right, anywhere in the chain, no pun intended, of an unregistered security of a crypto asset, you are liable for sending that off down the chain. So whether that's the team that created it or the exchange that facilitated trading of it, or someone who sold it. And so I actually just an hour ago got an email from someone who said, I'm literally looking into this right now. I see it as a big opportunity for 2018 to make a lot of money as a legal professional.
Wow. That's wild.
One example, but there it is.
Yeah, for sure. Well, we'll get to that for sure. Travis, tell me a little bit about your background with Point72 and now ICO Fund.
Yeah, sure. Thanks for having me on. Appreciate it. Frank, always good to hear from you. So I've been out of college about 10 years, and 9.5 of that was in energy investing. So I spent 4.5 years at a hedge fund called Magnetar Capital in Chicago. doing long, short energy equities and non-control private equity and debt, kind of broad investment mandate up and down the capital structure, long investment horizon. I was there from 2011 through the middle of 15. So that was kind of the go-go years in oil and gas. When I joined the energy business at Magnetar, was managing about 250 million. When I left, we were managing 4.6 billion. So I had pretty massive AUM growth over that period of time. And then I left in the middle of 15 and took a job at Point 72 as a portfolio manager. I was running a $200 million long short equities book there, energy and materials equities, a little bit of commodity, a little bit of options. I am not a tech guy, not like an early adopter kind of guy. I think Alexa is big brother. I don't own an Apple Watch. So the first time that I, discovered Bitcoin was when Silk Road got shut down, just from a fascination perspective more than anything. Like you were mentioning, like, look at these crazy drug dealers that made this magic internet money so they could go buy drugs on the internet. That's, just wild. And then when Mt. Gox got hacked, not too long after that, it was sort of confirmation to me that it wasn't really an investable asset class, because I didn't have any way to try and mitigate or price in this risk that I could wake up one day and somebody stole all my stuff.
Sure.
And not being like, a hardcore developer or digital security kind of guy, I felt like if anybody was going to get their stuff stolen, it was probably going to be me at that time. And so really didn't pay that much more attention to it. So just going about, energy hedge fund investing. And fast forward to the back part of 2016 when BTC price started rising again. I started reading more about it. Spring of 17 when Ethereum and the ICOs all started going crazy, I started reading more about it. And then one day last summer, I just came into work and kind of stopped doing my job and just swan dived down the crypto rabbit hole. Started spending almost all of my time reading about crypto, go to the gym, listen to a crypto podcast, go home, sit on the couch in the dark, read more about crypto, wake up, do it again. The great thing was by the time that came around, there was this enormous wealth of information available for free on the internet that you could sort of just, go about, understanding how all this ecosystem came together. And there was a bunch of things that I didn't understand at all that you just sort of plod down the path of like, okay, this is a Merkle tree. Okay, this is,
right.
SHA-256. Okay, this is like a ZK snark. Okay, this is Byzantine fault tolerance. Like all these different concepts, and you start kind of adding them up and realizing how revolutionary this technology and this emerging asset class could be. And so I went to senior management at the end of September and I said, look, this blockchain thing is going to be completely revolutionary. It's a once in a generation type of deal. I don't want to be an equity long short portfolio manager anymore. I'm going to make a career change. I told them that under the assumption it was going to mean I was going to leave the firm, which I was ready to do. Then I stuck around another couple months talking to senior management about what a crypto business would look like. At Point 72, they made the decision they were not ready to make a formal move into the space at that time. Totally get it. So I left the first week of December, left on great terms with those guys, and started making my way through this ecosystem. And I was not dead set on starting my own fund when I came out of Point 72. So I was reading in Autonomous Next and CB Insights that there had been, 200 and something crypto funds started in the last 18 months. And so I thought maybe I was a little late to the party. But as I started navigating my way through, meeting these different fund managers, talking to investors, it became apparent to me that there was a pretty severe lack of institutional grade investment sophistication that was being deployed into this asset class. And the types of things that I think I took for granted working for two world-class hedge funds in terms of how to build an investment business and a framework and putting processes inside of that framework and building tools that help you execute those processes to generate attractive risk-adjusted returns on a repeatable basis, like by and large, that just wasn't really being done. So that looked like opportunity to me. So I started having conversations with now my business partner, a guy named Timothy Lewis, who was serial tech entrepreneur, network systems engineer by background, had been sort of poking around at the space from the very early days, 2010, 2011. He had moved out to Los Angeles. He was a senior advisor at a group called DNA, Distributed Network Advisors, which is like a merchant banking and advisory services firm for pre-ICO. So like kind of like an incubator or an accelerator for emerging crypto assets.
Sure.
So I started talking to him about raising a fund. And I moved out here I moved from New York to Los Angeles the first week of March. So I've been out here a little over 3 months and have been blowing and going on raising Ikigai asset management since then.
Are you using some of the same strategies that you were familiar with, in your traditional financial career, if you will?
Yeah, a lot of it. So our investment strategy at Ikigai is based on the 4 foundations of qualitative research, fundamental valuation, quantitative tools, and event-driven catalysts. And we stand up our active portfolio management strategy on top of those 4 foundations and go deploy capital dynamically into a handful of different strategies that sit at kind of different places along the risk-return spectrum. And we deploy that capital based on the relative attractiveness of one strategy versus another when looking at the world through the lens of those 4 foundations. And that's a process that is what I did over the last 7 years at Magnetar and at Point72. The term quantamental was a term that got thrown around a lot at Point72, just the intersection of fundamental investing and quantitative investing or harnessing big data to help humans make investment decisions. And I strongly believe that there's a lot of opportunity to generate alpha at the intersection of those 2 things within this new asset class. And so we're building Ikigai to go and capitalize on those opportunities.
Gotcha. So what are, if you're able to say, some of the qualitative and quantitative ways that you guys are getting at some of this alpha?
Yeah, sure. So from a qualitative perspective, it's just understanding, having a front row seat to this asset class, and it's emerging. It's very early. The most fundamental pieces of this puzzle have not been put in place yet. So you got to spend a lot of time evaluating both existing crypto assets and emerging crypto assets, and looking at it through the lens of role and usage and features of that specific crypto relative to other cryptos that look sort of like it. Evaluating roadmaps, evaluating teams, talking to teams, evaluating the community, which developers are doing what. That's like kind of the qualitative sleeve. Mm-hmm. And then on the quantitative side, it's a whole process of not just technical analysis, which certainly plays a big role in trading crypto, because so much of this is speculation. And speculation is driven, at this point, so much of this is speculation, and so much of speculation is driven by fear and greed. And technical analysis helps to give you a lens into having sort of a barometer of where that fear and greed sit. But it's also doing things like measuring community vibrancy and taking into account just developer activity, size of GitHub, and just type of activity that's going on there, and harnessing some of these data points, things like wallet addresses and transactions per day, and all the different looks that you get into order books within crypto, which is a source of information that you don't have in traditional asset classes. Just about harnessing that raw data, synthesizing it, doing data science on it, and then drawing conclusions from it to go make investment decisions.
Gotcha. So I have a question for you here, and this is one that we struggle with kind of from an understanding standpoint as a business, as to kind of why it still exists, but also each of us here at ICO Alert, we like to invest personally in cryptocurrency as well. But the market moves to this day, at least to some majority degree, it seems, with the price of Bitcoin. So how does a fund manager like yourself account for that when investing in these other assets?
Yeah, that's a great question, actually. So you do some pretty easy quantitative analysis to assess correlations across different crypto assets. So you get a sense of how correlated the markets are or are not to Bitcoin. And there are periods of time, like today, where the entire asset class is moving more or less with Bitcoin, and Ethereum less so. But so much of the overall individual moves are really just a function of what BTC is doing. We're at a period of high correlation right now. There have been periods of much lower correlation. And as you move out into the future, I feel like the correlation to Bitcoin is going to decline over time as this asset class matures and people start getting a better understanding of the differences between, Bitcoin and decentralized app platforms and various different utility tokens that have specific use cases. And to a certain extent, you want to build an investment framework that is allows you to kind of skate to where the puck is going. And the puck is going towards less correlation across various crypto assets. And it's going to start looking more like a stock pickers type of market as we go through time.
Gotcha. I want to kick this back over to you, Frank, because certainly maybe as more of a minor or medium problem in investing in these various crypto assets is that during times of high correlation with Bitcoin price, it presents difficulties. But as you said at the beginning, regulation is a big one too. So kind of touching back on Ethereum kind of quote unquote not being deemed a security, but there still being more issues. What are you hearing on your end? What can people expect over the next couple months?
I mean, there are so many things that are, or rather questions that are hanging over this space, right? And creates a lot of uncertainty, which creates a lot of opportunities for guys like Travis. But when thinking about where the opportunity is at the end of 2018, or rather the end of 2017, everybody was thinking about when's the ETF, the exchange traded fund that trades publicly, open to non-accredited investors, that offers daily liquidity. When is that going to come to market? We had dozens, I think, or at least more than 10 filed with the SEC, and they basically said to all of these issuers, we don't want any of these to be trading at the present moment. And so the question is, well, when's that going to happen? When is the SEC going to become comfortable with that coming to market? A couple months pass, we don't really hear or see anything more from that. Now the new hot topic, it seems to be, is custody. When are we going to get an institutional, aimed, qualified custodian that will attract folks outside of the crypto fund market? You have a lot of folks coming to market like Coinbase and Kingdom Trust, who all have what they call a custody product, but all of their clients that they've announced so far are just cryptocurrency hedge funds or really small asset managers. And so those are two things, right? When are we going to get an actual qualified custodian that is large enough and has the experience to deal with really large asset managers? And when are we going to get an exchange traded fund? And I don't think, or at least a lot of the people I talk to don't think that will happen until, and I'd like to hear Travis's thoughts on this too, until we have at least a year or so of a sort of educational period. Because right now, it is just still so nascent to a lot of these large firms. And, I reported on Fidelity, for instance, having a crypto VC fund within the firm, first to report, still very, very, very tiny, and something that they wanted to keep very, very, very secret. When you think about what will bring large asset managers into the market and what will make regulators comfortable with an ETF and with deeming someone as a qualified custodian, regulators deeming folks as a qualified custodian, it's going to be educational. Both are going to be an educational transition. There's still a huge knowledge gap, and a lot of these large firms aren't as agile. So I was in a really, really big bank on the trading side not too long ago, and sitting on the guy's desk was a report from a junior level employee, how we can use, or rather the way we can open up crypto assets to our high net worth clients. And, this thing's just been sitting on his desk for months. He's looked at it, but nothing else has happened. And at the end of the day, a lot of these firms, they're all looking at it, but it's still going to take a long time for them to really understand what's going on here. And at the same time, it's going to take time for regulators to, get some of these products that will create the bridge for those larger investors to get on board.
Yeah, it's It's tough because I look at it and I agree with a lot of those points. But the biggest one I think for me still goes back to that regulatory uncertainty, right? Everybody's busy. I think if we get some certainty, we get some firm rules to follow from someone like the SEC, now all of a sudden pressure is put on your larger institutional players to say, hey, this is now possible. Not only do you currently not have to just learn about it, but you also have to go and look at risk at a completely different level than you would any other asset. So it's tough. It's somewhat of a chicken and the egg scenario.
It really is.
From my point of view, Travis, what are your thoughts?
Yeah, I think from a regulatory perspective, we can you can throw a dime down a wishing well and wish that the regulation that was going to govern this wasn't written in 1946, but the Howey test came about in 1946, and we have every indication to think that that's going to be sort of the main piece of I guess, judicial law that was put in place that's going to help us sort of understand how regulators are going to move through this. Getting a CBOE future for Bitcoin opens the door to a Bitcoin ETF. Getting this ETH ruling opens the door to getting an ETH future, non-physically settled future, and that opens the door to an ETH ETF. Goldman getting in a position to offer, synthetic directional BTC exposure to its high net worth clients. That was a step that sort of was the result of getting some regulatory clarity on how Bitcoin was going to be treated. And then the other thing that they're kind of going through right now, think of that as sort of one end of the spectrum, the very, very big end of the spectrum. And then at the other end of the spectrum, you have enforcement actions that are coming against, the most scammy ICOs, like the ones that are just the most blatant violators. And so regulators are taking a shot at cleaning up that sort of far end of the spectrum, mm-hmm. and prosecuting those and enforcement actions against the really scammy stuff. And then they're taking steps to give some more regulatory clarity around the sort of big end of the spectrum with the Bitcoin and Ethereum. And then, another thing that we know they've been poking around at now is price manipulation. They a few weeks or a month or so back, they issued some subpoenas to multiple crypto exchanges, and it's pretty apparent for anybody that sort of actively trades crypto that there is a lot of price manipulation and sort of whale collusion, mm-hmm. that's happening in this space right now. And you're going to need to clean some of that up. You've got predatory algorithmic market making. And this is something that we saw at the beginning of the days of electronic trading, going back to, I guess, the late 2000s, early 2010s, where algorithmic market making first came into traditional asset classes. And you had some predatory and sort of spoofing type of actions that were happening there. And, it happened for a little while, and then the regulators came in and cleaned that up and made it, a better place for all market participants to exist. So regulators are going down that path as well too with crypto. And I guess I would just say it could be a lot worse in terms of the way that regulators are acting towards this space. So they are making moves in the right direction.
Much worse is definitely, or it could be much worse, is definitely part of the verdict that we heard whenever Ether was deemed not a security. But kind of at the heart of this whole conversation, and this is one that people within and with outside of the cryptocurrency industry have all the time, is really, I think what we have is the cryptocurrency kind of philosophical approach butting heads with traditional finance and regulation, right? Where inherently cryptocurrency was designed in a way that makes it very difficult to fit within the Howey test or fit within current regulation. So, my biggest fear is that we being the United States, for example, right? When you think about the US versus other countries, we screw this up, right? And the regulation comes out and it is super detrimental to this awesome, new technology, and others follow, like the UK or whomever. And now all of a sudden we kind of set ourselves back in a variety of different ways from a regulatory standpoint. Travis, what are your thoughts as somebody who is obviously very bullish on cryptocurrency and various crypto assets, but also understands that, say, for example, your clients or the money that you manage want that, regulation to some degree, at least I would think, correct me if I'm wrong, and how the philosophical approach of crypto butts heads with that.
But butts heads with it in what way?
Cryptocurrency.
Sorry, I just want to make sure.
Yeah, no, totally. So cryptocurrency designed as something to exist without a central party, right? To be something that more or less can't be policed by a government. It's something that can decentralize the power away from a governing body, right? So just kind of the broad philosophical approach of cryptocurrency, right? Of Bitcoin way back in the day, my point is that I think inherently that's a big piece of this conversation is, can we even regulate this in a way that it will be possible for the SEC or a governing body to keep up with it, because it's designed in a way to ensure that they almost can't?
Yeah. Okay. Got it. No, I think right now, from a tax perspective and from a regulatory perspective, if I open up a Binance account, I've got to take a selfie holding my passport. Right. And there's a pretty clear, gateway in terms of KYCing new customers. And that happens on crypto only exchanges like a Binance. And it certainly happens on crypto to fiat exchanges like a GDAX. And I think from Uncle Sam's perspective, as long as he feels like he's got a good handle on the gateway from fiat into crypto and back again, then Uncle Sam feels pretty good that he's going to get his from a tax perspective. And so I think of that as kind of the near term. The longer term it's a lot harder to have a view on that. Can you make the argument that Bitcoin, undermines the US dollar on a long-term scale or the euro on a long-term scale? Yeah, I think you can make that argument. The way that plays out in terms of the interplay amongst market participants and those governments that issue the fiat currency, it's just way too hard to say. And it's a long-term thing. And I don't think you have to have a definitive view on what that path is going to look like in order to, make attractive investments and find attractive opportunities in this space today. So I think you want to put yourself in a place where you've got a clear front row seat to how that develops over time, and just know that sort of this ship is probably sailing in a direction where at some point it may seem more at odds with government-backed fiat currency, but we're such a long way away from that, right? Mm-hmm. What percentage of the U.S. population owns any cryptocurrency at all? Right. And it's certainly in the low single digits, right?
Right. Yeah, absolutely, 100%. It's long-term is definitely tough. Frank, from a short-term perspective or ultra short-term, timelines in cryptocurrency, as you both know, it's like every week is a month, every month is a year. But in the next weeks, or say next 2 to 3 months, what are you hearing? What can we see?
What can I tell you for certain?
Relatively for certain.
With almost 100% certainty that you will continue to see over the next month, 2 months, more and more people flee. I mean, this is the most interesting phenomenon to me. People fleeing Wall Street, and you'll see a hire soon by Coinbase. Hopefully I'll be the first to report on it. But they've already picked up, 3, I think, at my last count, of note from the New York Stock Exchange. They have a slew of guys that they grabbed from DRW, the trading firm in Chicago, and a bunch of folks from CME Group, the exchange operator, to build their matching engine, which will allow trading firms to co-locate, that is, hook up to the exchange to access a picture of the market in a speedier way. That's set to be done, my sources tell me, by 2019. But the talent raid from the crypto world on Wall Street, you will see more and more hires over the next couple months. And it points to a lot of what they're aspiring to be. Over at, I've reported that Paxos brought over a gentleman from Citadel, a trader who had been with the hedge fund for, I think, a decade. Mike Novogratz just picked up someone from Citi who was a sales guy working with hedge funds as well. And they're really building out. You're seeing a lot of building out of, and this is what I'm most fascinated in, are services at the intersection of crypto and Wall Street. And what you were alluding to, I think, is ironic, right? You know, these firms, which are some of the most well-known in the crypto space, are, in a sense, creating these layers of intermediaries, which, you know, is pretty ironic. But I think you'll see more of that.
Gotcha.
Yeah, I'd echo a lot of that. I think over the next call it the back part of this year, you're going to continue to get more regulatory clarity. I think the talent exodus from Wall Street into crypto is going to continue. I think you're going to see the overall quality of the ICO market continue to increase. In summer of 2017, you could ICO a flaming pile of dog shit and raise $30 million bucks in 10 days, and you could flip out of that in like a 45-day round trip by the time it got on the exchanges, and you have your money back out and safe. And like those days are long gone. And ICO quality, I think, is continuing to increase because market participants, like the price action year to date, has certainly taken, you know, some of the starry-eyed allure away from this space, right? And people have kind of woken up and sobered up about where this technology is and how far we need to go before we, you know, all this stuff goes and changes the world. I mean, it is happening, and it's for sure going to continue to happen. But I think people are getting a little bit more sober about their expectations of the timing, and ICO quality increasing is just a result of that. And then infrastructure, institutional grade infrastructure, both on the custody side and on just like prime services type of things, and creating interfaces that look like traditional asset class interfaces for institutional investors to go and buy and sell crypto, and just making that look and feel more like what institutional investors are used to. I think all those things are going to continue.
Who do you get your prime? Like, who is the prime broker in this space? You know, when you think about how Goldman killed it, you know, in the 2000s with hedge funds making tons of money off prime broker. Who is that in crypto? Who are you lending from? I mean, I don't know if you want to name it per se, but I just feel like it doesn't exist.
Yeah, I'd say in broad terms, BitGo Kingdom Trust is doing interesting things on the custody side. Noble Bank is probably the furthest along in terms of making kind of back office interactions look the most like a traditional asset class. We have relationships with both of those entities. You know, Borrow's still hard to come by, but Gemini, their OTC desk, is providing some liquidity on the short side that makes that a little bit easier. And just all those things are, again, you kind of have to skate a little bit to where the puck is going. Mm-hmm. And you talk to a bunch of different entities that are throwing a bunch of money and a bunch of a bunch of money and a bunch of people at trying to create these institutional grade infrastructure solutions for crypto asset market participants, because they know that the need is there. So like it's getting solved. These things they take time. So
shifting a little bit towards ICOs, kind of hit on a couple things that we've seen this year thus far. Travis, you know, the price decline makes it harder to invest in an ICO. You buy Bitcoin at $16K, it's at $6,500. I'm not really ready to shill out some Bitcoin just quite yet. So what we've seen is that it's kind of opened up the doors for private money to return. 2017 was all ICOs. Everybody in directly in the ICO space was talking about how venture capital was dead. Right? It's over. ICOs are here, and then we see a huge market crash and funds disappear. You know, these new private sales have emerged. We also hear about STOs. Are you guys at Ikigai investing in ICOs still, or are you kind of holding off? What's your strategy around ICOs right now?
Yeah, we are. So we're evaluating opportunities. So 25% of our AUM is dedicated to venture stage emerging pre-ICO investing, both tokens and the equity of the entities that are issuing tokens. And then 75% of our AUM is in a long-short multi-strat. So that's liquid hedge fund strategies applied to the crypto asset space. So looking at the ICO market today, again, like last summer, a white paper plus hype would get you a bunch of money raised. It would get it raised very quickly. Those initial investors would get 10x returns on bad projects. The crypto economics were not well thought through, very kind of ad hoc token structures, investor access, free for all in terms of like nobody's worrying about KYC, nobody's worrying about accreditation. And then from like a use cases perspective, everybody's just like throw it all on the blockchain, right? Like, I mean, it really looked like, a lot of the .com hype. And a lot of that is cleared up just between, then and today where the platform expectations in a lot of cases is you need an existing business that has existing users to make more of a compelling case. Like if I'm going to go do an ICO, to put coffee tables on the blockchain, well, like unless you're one of the best coffee table makers, like already, like there's not much interest in that. Because even if you have a compelling sort of like, investment thesis on why that's going to work, like whoever is the number one coffee table maker, like they may just come along with their ICO shortly thereafter. And because they have the, real world domination in the coffee table market, well, then they're going to like blow your non-existent coffee table ICO business out of the water. Right. And you're seeing lockups that are being put in place, right? 6 to 12 month, 12-month lockups are getting more and more normal for the initial private pre-sale round of ICOs. Bad projects are getting ignored. Certainly good projects, or I should say great projects are still oversubscribed. And then crypto economics are moving more into front and center in terms of what investors are looking at, like just the manner in which the supply and demand of a token interacts with the actual business use case of the technology. That's not an afterthought anymore. That's now front and center with people understanding it. And that's a function of this market developing and becoming more sophisticated, and folks on the valuation side pointing out things like the velocity problem within crypto and how are you going to solve that, and how's your token structure take some of that into account. And then looking at the investor access, like one, you have to be accredited in almost every case now to do a US ICO, and you have to do full KYC. And more the sort of lighthouse and anchor entities, the power players within this ecosystem, those guys are getting the looks at the highest quality deals early, because it does signal to the rest of the market when you bring on, like a DNA, for example, out of Los Angeles, who we have a great relationship with, or, some of the, like a Galaxy Digital or a Polychain or somebody that's been doing it for a long time. And yeah, so I mean, that market's maturing, and it's going to continue to mature. And a year from now, if you think about how far we've come from a year ago to today, a year from now, we're probably going to go that far or further from where we are today. So.
Do you see security token offerings having an opportunity to kind of take off like ICOs did this year in 2018, or do they still have a ways to go? What are your thoughts there?
The infrastructure needs to get put in place, and it's quite nascent right now in terms of security token exchange platforms, but it's getting there. But the valuation ramifications around a tokenized security, like take a piece of real estate, for example, it's really analogous to an existing asset class, right? Real estate investing has been around for a really, really long time. So what you're actually just doing is providing liquidity to asset classes that previously either had, none or much less. And the ramifications around that they're just not as moon-worthy, I guess I should say, as something as crazy as, wow, this thing has value, but it has no claims to revenues, earnings, cash flows, or assets, but it is more instead like a claim on network effect, which is like, kind of what a utility token sort of is. Yeah, so I think the hype around tokenized securities is just not going to be, I mean, it's great, and there's a multi-decade runway to go provide liquidity to previously illiquid assets, but like just the the potential for that to just get hyped up beyond belief, like what we saw in the back part of 2017 with cryptos, I think is not there. And that's probably a good thing.
Sure. Frank, do you feel the same?
Well, when we think about a lot of liquid markets, I mean, even small caps, U.S. small caps, I mean, if you talk to any big trader, and, Travis probably knows this as a hedge funder, when they try to make a trade on, any U.S. small cap, you're going to get your hand chopped off in the fan and as part of the process. And so there is room for, STOs to not replace all of stocks and bonds, but certainly those areas that are the most illiquid that, could facilitate better trading. And there are solutions being done all over the place to fix this problem. I mean, you had Reg A Plus, right? A way to raise $50 million to spur capital formation. This is a question that's been hanging over the stock market for a long time. And there's a huge opportunity, or at least a good opportunity for STOs to help chip away at some of those issues. And when you look at tech companies, right, a lot have been very wary of going public. And so you see Spotify doing a direct listing. And when you look at this market, you might think, well, maybe a company like Spotify would be interested in doing an STO once we get that infrastructure, as Travis said, in place.
Sure. Frank, give me some information, and our listeners as well. Perhaps they're a retail investor out there who have been trading cryptocurrency for some time, or they invest in it for the long term. STOs come around. They are or are not considered an accredited investor. What possibilities do they have of investing in an STO, and where would they do that, and what are some of the other requirements that they would have to abide by to purchase or hold these STOs or trade these STOs?
Yeah, that's a good question. I'm pretty sure most are done through private placement and not open to U.S. Non-accredited investors. So I'm not entirely sure if that's possible yet. I don't know. Maybe Travis has some more insights into that.
Yeah, there's not going to be much of a path for non-accredited U.S. investors to invest in emerging crypto assets right out of the gate, and I'm not so sure that's such a bad thing. We can have a separate conversation about whether or not we should change the definition of accreditation to something other than making $200K a year for the last 2 years or having $1 million worth of assets liquid. Mm-hmm. But and I think that's a conversation worth having. I think there should be a test that you have to pass, like a 50-question multiple choice test. And if you're smart enough to make a certain grade on it, then you're smart enough to go bet your money and maybe lose all of it. There's an amount of irony that exists that America allows you to advertise for lottery tickets and to let the gambling industry be as massive as it is in the United States. But like, if I don't make $200,000 a year for the last 2 years, then I can't invest in an ICO. It's
Sure.
I don't love that.
I think if they register under a Reg A Plus, it would allow them to be open to non-accredited U.S. investors. Reg A Plus is part of the Jobs Act, which allows companies, typically smaller companies, to raise upwards of $50 million, less regulatory scrutiny for those firms. I would imagine if they registered under that, then it would be open to non-accredited U.S. investors. I don't know exactly how. I don't know if one's been done that way though yet, and where one would trade such an asset. I don't think we're there yet.
Yeah, there's a ton that needs to be added in. I mean, any kind of brand new crypto asset, as we'll call it, there are a handful of boxes that need to be checked. But what I was kind of trying to get at with the STOs is that, we see room for both ICOs and STOs. Airdrops are another huge funding model that we've been talking about as well, especially with, new blockchain projects like an EOS, which ICO Alert is inherently hot on. But, as far as ICOs and STOs go, it seems to me that STOs will be reserved, the larger investors, and reserved for the larger companies, less of your, say, startup kind of crowdfunding, and ICOs will still exist there. Assuming, of course, all of this, regulation gets worked out, and, hopefully the U.S. is set up to have that ability and innovate there. But I would agree, with a lot of your points, both of you, that I don't see the same hype that many do with STOs, where they kind of see it as like the second coming of an ICO, and that doesn't seem to really click for a variety of reasons. So we'll see. It'll be interesting. Travis, in your position, do you see the possibility of STOs or I guess just regulation in general, right? Kind of these new barriers to entry being created where you have to be accredited, or you have to do KYC, or you have to do whatever, right? Do you see that hurting the quote unquote crypto landscape?
No, I think accreditation needs to exist. I just wish that they would put the questionnaire concept in place instead of using the current definition of accredited. You don't want just somebody that's really not financially savvy or not paying much of attention to this to be duped into or sucked into putting money into something, and they're just not in a position to do the diligence about whether or not it's an attractive investment opportunity, or just to fully understand the risks. Like, you need to have some gateways around that. I just think that making $200K a year, having $1 million, for the last 2 years, or having $1 million in the bank is like just not the best way to do that. So,
what would be some questions that you plug into that questionnaire? Do you have any on the top of your mind?
Yeah, I mean, I think it's probably just simplistic stuff around understanding risks and how you can lose money, and understanding the relationship between risk and returns, and understanding the difference between a well-established asset class and a nascent asset class, and understanding that in something that's brand new, in many cases, it's going to be worth zero eventually. I mean, ask any VC, right? A VC makes 10 bets and 8 of them go to zero. One of them breaks even, and the 10th one, he makes 50 to 100 times his money. Well, for an average Joe for an investor needs to understand that he is putting money to work in that type of environment. 8 out of 10 go to zero. Like, you need to understand that before you start putting money to work.
Right. Yeah. And it's almost unfortunate to some degree that hype cycle back in December, January, February happened to such a large degree. We were talking about this in the office. I think it was end of last week. And that what if that bull market, right? What if it wasn't so big and it was actually steady growth versus kind of like a rocket ship that went up for a while and then just completely exploded, right? Like, where would we see that education and that understanding today? Because it seems to me that a lot of it has less to do with investors educating themselves, or people understanding that, hey, this technology is relatively brand new and there's a lot that needs to happen, especially from an infrastructure standpoint, versus it just, it's all dead, right? There's no excitement. It's not popping up as much in your mainstream media. It's dead, right? Completely done. So I don't know. It's hindsight's 2020. You wish maybe it wasn't so large, but either way, I think we're headed in the right direction for those newer investors to hopefully understand, hey, listen, like this, there are many layers to cryptocurrency and ICO investing. It's not as simple as looking at a few ratios or a few different metrics. There are huge layers of game theory and tech, and there's all this market manipulation going on, for example, all things that you have to consider before you invest. But Travis, for that, say more experienced investor, somebody who has been trading or investing in cryptocurrency for 11, 12 months or a couple years, maybe they've even considered launching a fund of their own, but haven't kind of made that leap like you did. What's, one or two pieces of advice that you could give them at a kind of a bear market right now, as they continue and move forward and learn more and kind of mature with the industry?
I guess one quick comment about your hypothetical. I think,
sure.
You can sort of wish that humans would act a certain way, but that's just like not the way that humans act. I mean, humans markets are not rational,
right.
and market participants are not rational, and FOMO is super real.
Yep.
And when the amount of hype that was being generated around this asset class in the back part of last year, it for sure got way over its skis relative to where the tech was. You would make an argument like Carlotta Perez. I don't know if you've read any of her stuff before, but she talks about these technology cycles and the boom and the eventual bust is part of investing in emerging technologies. And
yep.
the boom and the capital that flows into the space during the boom times, it can allow for when busts to happen, there's capital that's been raised that can fund during the bust time. And the boom brings a lot of attention to the space. It's brought a ton of developer talent to the space, right? It's hard to find a really talented developer these days that isn't at least poking around at crypto in one way or another. Mm-hmm. And a lot of them are running to this. And that's a function of what happened over 2017 and the light that was shined on this asset class. And now we're moving to a place where those builders, they need to go build the technology to get it up to where expectations are. And that's happening in real time. And it's going to continue to happen. And when you think about combining Moore's law with Metcalfe's law, with open source software development, with instant worldwide information dissemination via the internet, you put those four things together, and it is a recipe for growth and evolution and adoption rates that we have never seen before in anything else ever. And we are just at the tip of the iceberg for that. Wait until one of these things has a compelling use case relative to the status quo. And then you have economic incentives that are just juicing that use case. You're going to see a growth rates that we never even, humans aren't very good at understanding nonlinear growth, right? We're just not. And you're going to see growths out of this asset class that's just going to be staggering. And I look forward to seeing that. But I think going back to your original question, which is things to be focused on if you're experienced in this asset class and interested in investing in it, is you need to do your own research. You need to spend the time to read about the projects, and you need to utilize this ecosystem. One of the most refreshing things coming out of traditional hedge fund investing and stepping into this asset class has been how communicative and how collaborative the ecosystem participants are. The smartest minds in this space, the thought leaders in this space, they tweet regularly and they write, Medium posts on a regular basis, and they go to conferences and give talks. And those talks are, in a lot of cases, you can find them on YouTube or they go on podcasts. Right. Mm-hmm. And there's an enormous wealth of information with the smartest guys in the space talking out loud about how this thing is developing. None of that is available in traditional hedge fund investing. It's incredibly secretive, and people don't share ideas. And so that's one of the best things about crypto assets. And as an investor, you need to try and take full advantage of that with just meeting other people in the ecosystem, whether that's digitally or in person, and collectively pooling resources together to come up with the best solution. Nobody ever thought that Wikipedia would be a better encyclopedia than Encyclopedia Britannica. You ask any psychologist, economist, any expert on anything prior to that happening, they would have told you there's no way that ever happens. And then you look and see collectively sort of what people are able to do. And the crypto ecosystem is a great example of that.
And to your point earlier, it's one that has underlying, incentives that don't usually exist in a lot of the same kind of, network effect models, right? So this is something that we talk about a lot in the office too, is, okay, yeah, it's the infrastructure stage, right? You've got a lot of blockchains who are building a presence in the ecosystem around being scalable and usable, and transaction speed has been a big one. How many transactions per second can you do? Infinite? All right, great. Take my money, right? But past that, to your point, for the suggestions for more experienced investors, adoption, right? When does that come? How does it come? And what happens if we don't see that when infrastructure is ready? That, to me at least, and Frank, I want to kind of get your perspective on this too. Your infrastructure versus adoption. That to me is the largest risk to the current ecosystem, and that the infrastructure continues. We have the slow growth, we have the ups and downs, and maybe we get a little bit more regulatory certainty, but if that adoption does not come for whatever reason, it's going to be very difficult in the future. So it's a big one. I think it's one that not a lot of people are really talking about.
Well, yeah, I think that's. I mean, they may never come, but at the same time, you have to remember. First off, across Wall Street, I mean, folks are working on projects that are tied somehow to the development and the maturation of this ecosystem, and from the trading perspective, the development of the market structure. But at the same time, and sort of connected to this idea of that run up at the end of last year, which was, I think, triggered, and I'm no market expert, but I think in part triggered by the CME launch of futures and the enthusiasm and the excitement about what that could mean next for the market. I mean, I really think people thought there would be an ETF the next month. And folks need to think about the fact that this market is very, very new. And so back to the head of data at ICE, the Intercontinental Exchange, a woman by the name of Lynn Martin, she said to me, you cannot compare, or if you try to compare crypto market structure and U.S. equity market structure, it's like comparing neon fluorescent signs and apples. I mean, you just can't compare the two. There is so much work that is left to be done. And, maybe it takes a really long time. And going back to my first point, maybe it takes a long time to educate a lot of these larger firms, and maybe it frankly, who knows? Maybe it never happened. But there certainly is a gap.
Yeah.
I hope that wasn't long-winded. But.
No, that's perfect. I mean, that's the beauty of what attracts people to this industry. It's that chance, it's that unknown. So there's not a ton of certainty in things, but there's incentive structure and game theory and this brand new technology, and that's what brings people here.
Yeah, and it's not going to take that long. We may, in technology investing or just technology development in general, we have a tendency to, overestimate the next 2 years and underestimate the next 10. And I think that is without a doubt, the case for crypto assets. Distributed ledger technology is a new foundational protocol layer for global information exchange. It's like TCP/IP or HTTP, and those previous protocol layers didn't accrue value within them, but instead they facilitated value capture at the application layer sitting on top. But now, because of crypto economics, distributed ledger technology can capture significant value via price appreciation of that underlying crypto asset associated with that DLT. And there's a circularity amongst the ecosystem participants that starts with speculation. Speculation drives more developers. Developers bring more miners. Things get faster, so that brings more users. Users bring more actual consumers and merchants around it. And there's and then that brings more speculation, and there's a circularity to all that. And network effects are the primary driving force of those crypto economics, and it enables both value creation and capture at that protocol layer. And that's really revolutionary. And I want people to understand that, because a lot of times people say that, it's a bubble, it's so much speculation. It is speculation. And as we sit here today, very few people are actually using this stuff for any of its intended use cases. People are just speculating. But by speculating, I can stand at T0 and look out into the future and make a bet about what a technology might be worth. And it's a technology that derives a significant portion of its value from network effect. And I can make a bet about what that technology might be worth if enough users come to the technology where it gets pulled up the network effect S curve and gets to a point where the average utility per user is compelling versus the status quo. And speculation today allows that technology to get pulled through the bootstrapping phase and up that curve. That's never been available in the history of anything before. Mm-hmm. That's a really revolutionary concept. And the only difference between Bitcoin being overvalued today and undervalued today is what the future adoption rate of Bitcoin is. If more people come to Bitcoin, price is going to go up. If everybody walks away from Bitcoin, the price is going to go down. And as developers are continuing to run as fast as they can to this space, because crypto economics allows you to very cleanly and purely economically incentivize those developers to go build cool shit on DLT, you get to a point where you may think you're a long way away from it now, but it goes back to my comment about Moore's Law, Metcalfe's Law, open source software development, and worldwide information dissemination. You're going to hit a point in that curve, and it's going to go parabolic in a way that we've never seen before. And so you just, as a fiduciary running a fund, you just want to put yourself in a position to have as clear-eyed view as possible about how all of that is developing, and then malleability in your investment mandate so that, I can be sitting on cash, a significant portion of cash if market conditions warrant that, like today. Or, you can go make a really big bet when you see the Google or the Facebook or the Amazon or the Netflix come around to crypto, because they are coming. And, there's a chance that Bitcoin and Ethereum may be Netscape and Alta Vista. And we haven't seen the Google, and we haven't seen the Facebook, we haven't seen the Amazon. But it's coming because the talent's coming to build it, and they're economically incentivized to do that.
Right. Yeah, I would guess that we haven't seen the Netflix or the Google or any of these yet, as I'm sure many would. We're very early. And, as a crypto hedge fund manager, Travis, there's a lot of risk in the way that you communicate basically this pitch to those who say, aren't as used to these market dynamics as others would be, right? Others who are investing personally. So how do you as a crypto hedge fund manager get across to a high net worth client what it is that you just told us here?
Again, I want to be really careful just to let everybody know this is in no way investment advice in any form or fashion. This is like totally a conversation. There's a really good chance I'm going to be wrong about everything I say here. So do not make investment decisions based off of any of this. But we think there's a compelling reason to be investing at the pre-ICO level, because investing at the pre-ICO level to a certain extent, it informs your view of existing trading crypto assets. Like, for example, I can't really have a great view on Ethereum without having a view on EOS. And I can't really have a well-informed view of EOS or Ethereum without having a well-informed view of Hashgraph. And so you need to be in a position from an investment strategy perspective to have a look at that entire spectrum, and Ikigai has that. And then, going back to the sort of simple VC math perspective, there's going to be some enormous winners in this. There will be the Facebooks, the Amazons, the Googles, and the Netflixes. And there will be many, 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 many zeros. And the ones, you're going to have some ones that probably look like they might be Google at first, that end up being a zero. Just like Ask Jeeves looked like it was going to be, a Google for a minute, or any other dozens and dozens of examples. And you need to have an investment framework in place that gives you the clearest picture possible to evaluating how this ecosystem is developing. And that's how we arrived at our 4 foundations: qualitative research, fundamental valuation, quantitative tools, and event-driven catalysts. And that's your framework, right, that you go, and then you just got to make sure that you've got malleability in your investment mandate, and you're able to sit on a lot of cash. You're able to short if shorting warrants it. You're able to be concentrated in a position. If Lightning Network for BTC takes off, and it looks like that people are actually really using it, and it's getting adopted by merchants and things like that around the world, well, then it may make sense to have half the fund parked in BTC. So you need the malleability in your investment, structure to be able to go do that.
And certainly the investors in the fund that are comfortable with the risk and have some knowledge of the space to some degree, I would think too, right?
Yeah. In most cases, the more you know about crypto hedge fund investing in general, I feel like the more traction we've been getting with potential LPs, and I think the more you know about traditional asset class hedge fund investing, the more traction we've generally been getting with LPs as well too.
It probably decreases the amount of stress that you have, I would imagine, if you don't have to explain away all the little changes here or there, and there's a baseline level of understanding.
Yeah, but I mean that's true. But the flip side of that is as somebody that's gone and bet their career on the growth of this asset class, which I felt like was the opportunity of a lifetime. I also feel like it's my duty to go and inform, not maybe, less sophisticated investors, that's sort of one thing, but just say traditional financial institutions that don't fully understand how this asset class is evolving and maturing. I'm more than happy to take the, tens of thousands of hours of research I've done at this point and help folks understand why this is revolutionary and where we are in the cycle for this and what some of the long-term, potential is and where the risks are and where the attractive opportunities are, as an ecosystem participant. I feel like that's a duty that I have to help folks understand that may not understand it that well, but want to.
Certainly. Yeah. It's an added responsibility alongside a handful of other things. What's the difference between running a crypto hedge fund and being a traditional portfolio manager? What are some of the biggest pieces?
So traditional hedge fund investing, all your resources are essentially immediately available to you. I've got a Bloomberg terminal. I pay like $10K a month for my Bloomberg terminal. My Bloomberg terminal seamlessly plugs into Microsoft Excel. It has its own language. I can do all sorts of analysis, just with those two things, Microsoft Excel and a Bloomberg terminal. And, can do a tremendous amount of work with those two things. And there is no Bloomberg for crypto. Just getting good pricing data across all exchanges is a reasonable sized headache. And working with that data and then building graphical user interfaces to help, investors make investment decisions. Just that type of infrastructure is just broadly sort of plug and play available in traditional asset classes, and certainly much less so for crypto. The data goes back for decades when looking at stocks or bonds or FX or something like that. Whereas the data goes back, it's the data in theory for Bitcoin goes back to early 2009, but those are incredibly choppy markets. And I would actually make the argument that if you're trying to do data science, even looking at price action in 2017, we could have a conversation about how relevant that is to the current market environment that we're in right now. So it's a very, very new asset class in terms of doing data science on that stuff. There's no revenues, there's no assets, there's no earnings, there's no cash flow associated with most tokens, and so having all the dozens of metrics that you use for valuation purposes to tie that back to if I buy a share of ExxonMobil today, am I paying a lot or am I paying a little for that? Well, there's all sorts of different ways that in my prior line of work you can go about trying to decide that. And many of those don't exist for crypto. So you have to go find new ways to think about valuation. And then, I would just say the most foundational pieces of this asset class are not put in place yet. Like I said, Bitcoin may be, Netscape, and Ethereum may end up being Alta Vista. And it's just very early. The most foundational pieces are still moving around. And then the final thing I'll just say is that crypto trades 24/7, 365, and that presents its own opportunities and challenges for trading a market that never closes.
Yeah, you can't sleep. That's what it is. That's the answer. You just up all the time, right?
That is not the answer. No, good risk management. Good risk management is the answer.
Right, certainly.
Travis, I have a question for you.
Sure.
When you think about, the over 200 funds that exist, who are the customers for the main part? I mean, it is family offices. It's wealthy individuals. Is it now endowments? Are FAs starting to pay more attention? Who or which group is not invested yet, but is showing the most interest?
Everybody's showing interest. Everyone. Even the slowest money, like pension fund money and university endowment money is probably the slowest money on the planet, but they are for sure showing interest. But these are guys that take 9 months to a year to cut a check into a multi-billion-dollar hedge fund that's been, it's got a 3-year track record of producing very good returns in an asset class that's been around for decades. And those guys still take 9 to 12 months to cut a check, right? So you can't have this expectation that for something this nascent that, whatever Texas teachers retirement system is just gonna wake up and cut $100 million check to go, rip some ICOs. Like, that's just not the way these guys act. And that's fine. Broadly speaking, West Coast high net worth individuals have a lot of experience in angel investing and a lot of experience in seed and venture stage investing. So investing in an asset class this new feels pretty comfortable to them. A lot of them have tech backgrounds, so they can kind of get up to speed on the tech curve more. Certainly family offices are looking at a small percentage of their assets to deploy in this. There's definitely a spectrum of kind of understanding and I would just say sort of willingness to be interested in something like this across the family office space, but there's nobody that's not looking.
Interesting.
I don't know, Warren Buffett, maybe.
That we have seen for sure. That's a guarantee I think we can probably make. Cool. Well, gentlemen, this has been great. Really appreciate the time from both of you. Last thing that we typically do on this podcast is give a good way for our listeners to reach out or kind of follow along. Frank, in your case, read what it is that you're putting out. So, Frank, and then Travis, what's the best way to do that?
I have I just actually started up my newsletter again. You can, maybe I'll make it my pinned tweet, but just sign up for that. You'll see what I'm writing. Every Saturday morning, I'll send that out. And then Twitter, obviously, at FinTech Frank. But yeah, looking forward to having some of your listeners potentially reach out.
Awesome.
Best way to get a hold of me, Twitter's always good. Travis_Kling, Kling. And then Ikigai's website is ikigai.fund, IKIGAI.fund. There's a decent amount of information about my background, my team's background, what the fund is doing, and then just kind of various different PR or media type of appearances that we've been doing. So both those are good. Certainly appreciate the time, Mike and Frank. This was
thanks.
Really enjoyable.
Gentlemen, it's been a pleasure. Really appreciate it. Hope to talk to you soon.
ICO Alert maintains the only trusted comprehensive list of pre-ICOs and initial coin offerings. This Pittsburgh-based startup has grown to serve over 1 million users in less than a year. But how did it get started? Well, at first, the company was just an online tool for two brothers, Mike and Rob Finch, to keep a calendar of their favorite ICOs. After just a few months, the team has grown to over 14 team members and produced hundreds of ICO reports. These in-depth reports feature exclusive interviews and offer insight into past, active, and future ICOs. Head on over to ICOalert.com, meet the team, and use their game-changing My Portfolio function. Track your favorite blockchain projects. Become your own venture capitalist. Only at ICOalert.com.